wanted to bring you this chart. This is BTV 9237, available on the Bloomberg. It's very simple. It shows the S&P ploughing upwards, as we've seen over recent years, back to 2013. And then the spike at the start is the 2013 level of news interest in the shutdown story. Yeah. It was quite extreme. And again, we see interest in shutdown stories spiking up right now with this shutdown. But it didn't, the point being, it didn't derail the stock market rally, will it, this time?
Well, it wasn't long enough last time. But you remember, it came at a different time. I mean, now we've got an economy that's doing much better. You've got tax cuts. Sentiment's a little bit different. I think if you looked at the dollar, it often affects the dollar as much as it does the equity market. Because this is a sentiment judgment on government and government's ability to get things done. But it simply didn't go on long enough to affect things last time round. This time, who knows, but the differences don't seem that great.
They don't seem that great, so you would expect that we would carry on, as long as this is not too prolonged. Is that the key thing to watch out for? How many days, hours, weeks this could last for?
Well, the key thing for the stock market is we've entered earnings season. So people are going to look at earnings and those forward-looking projections based on tax cuts and think what that means. Sure, there's a sentiment issue, and if it went on towards the back end of this week, I think people would be concerned that the government really couldn't get things done.
I wonder, I mean, this is very different than, say, if we had one of the ratings agencies come in and say the U.S. is getting closer to a risk of default. That's the kind of thing that wakes up markets, isn't it?
That was definitely a different cocktail last time round, and you can remember people running funds were concerned when Treasury bills were going to mature. We're going to mature on Tuesday, we're going to mature on Thursday, and there was a lot of shuffling in sense to avoid that technical issue which money market funds certainly could have faced. This time round, you don't have that. That being said, at the heart of it, there is still a financial issue behind this, which is the finance of the US government and how close they are to any limit.
What is your outlook for the dollar, Rick? I mean, we've obviously seen the dollar have a tough time. I've got a chart here, 9017, that shows the U.S. dollar, the Bloomberg Dollar Index in white, over the last year, since the kind of Trump bump, has really come down hard. Do you expect this weakness to continue throughout 2018?
Well, I think the weakness was in part strength elsewhere. Europe did much better than expected. Certainly, Eurozone recovery was faster than expected, and that changed people's expectations of rates. But if you step back and say, what do we think the carry is going to be in the next year or two, it's still going to be pretty positive in terms of US dollar over other currencies. And that can be a really strong driver. It wasn't a strong driver in 2006, but it certainly was a strong driver in the late 90s. And I think we wouldn't want to bet against the dollar at this point. Certainly, it's not far away from fair value. We think it's got some way to go in terms of potential bullish trend, but more likely it will stay in a range.